Hey, this is Esteban, your mortgage mate, and making this video to talk about a home buyer stimulus program, or a program also known as a 2-1 buy down. And really going to cover, what is a buy down, what the benefits of, a buy down program are, and who these programs are really designed for. So a buy down, right? Going into what is a buy down? A buy down is an investment in the interest rate, and this can be for a temporary period, or it can be for the duration of the loan. So how mortgages work and interest rates, if you prepay interest, you can get a lower interest rate for the life of the loan, or in this case, a temporary period. Now, a 2-1 buy down or a 3-2-1 buy down is a temporary reduction in the interest rate that is actually paid by the seller. So the seller can actually reduce your interest rate for up to 3 years in this case. So to illustrate, I'm going to go over a 2-1 scenario, right? So if the seller is helping with the cost of this buy down, in a 2-1 buy down, you would have, say, a 5.25% would be your normal interest rate that you qualify for. And in a 2-1, your interest rate for the first year is reduced by a full 2%. So if you were at a 5.25, now you're looking at 3 payments on a 3.25% for the first year. And the following year, a full percentage reduction. And then after the first 2 years, your introductory rates are over, and then you're looking at the normal rate for the third year and beyond. Now, to give you a better example, say you were to purchase a home at $350,000, and you were doing, say, an FHA loan with 3.5% down. If you were able to negotiate a seller credit, right, on that property with just 2%, you'd be able to do a 2-1 buy down. So that with a FHA loan, you can negotiate up to 6% on your closing costs or seller assistance. But the 2% would be for a 2-1 buy down, and that equates to just over $7,000 that you're getting in assistance from a seller. So in year one, you're 2% lower. Your monthly principal and interest payment on this type of loan, right, $350, putting 3.5% down, would be just under $1,500. So each month for the first year, you're saving almost $400, right? And then the following, with a full 1% reduction, you're saving a little over $200 per month. Now, what's really awesome about a 2-1 buy down or a 3-2-1 buy down is the money that the seller provides is actually refunded to you when you refinance, if you refinance in under that temporary period. So say, for example, in this scenario, you were to refinance in under 12 months or at 12 months, you would be refunded a total of $2,442 from your buy down program. So when the seller helps with that assistance, right, in this case 2%, it sits in an account to pay each month during the loan, right, the first 2 years. Now, say interest rates come down and it makes sense for you to refinance at that time. If it's within that, before that 24-month period, any balance that's left over is actually refunded to you in the form of a check. So you can take that check and pay your mortgage down, or you can pocket it and do what you see fit. Now, the benefits flat out are, you save more money, right? This is basically money in your pocket. If the loan is refinanced later, it really translates to cash directly in your pocket. And so unlike points or closing costs, when you use your funds just for points or just a normal buy down, you just buy down the interest rate for the duration of the loan. In this case, you have a temporary time period, and if you refinance or sell, you get that money back. Now, unlike an adjustable rate mortgage, right? In this case, after the introductory period of those low rates, your interest rate is known. So in an adjustable rate mortgage, your interest rate can fluctuate after the introductory period, and it can adjust each year. So who is this program for? This is for buyers that qualify for the normal higher interest rate. You can't qualify for this program based on the lower interest rate, the introductory rates for the first couple of years. This is really for buyers that are expecting to earn more in the near future. So say, for example, someone that just started off in their career, like a doctor, an attorney, or you just graduated. This serves well to keep your housing expense, lower cost as low as possible for those first couple years as you begin to get set up. This is also great for buyers who expect interest rates to come down. So if, say for example, a family that's looking to upgrade their home in the near future, however, is kind of opposed to the idea because interest rates are higher, this would serve well as a strategy for them to shop in the marketplace while there's negotiation leverage for them. And then they negotiate these buy downs. So for the first couple years or 3 years, they have a lower mortgage payment. And then once interest rates come back to a lower, once we're in a lower rate environment, you refinance that loan and save any additional money in the escrow account. So that's really who I see this program for. Really anyone trying to make their payment more affordable for the first couple years, or someone that's looking to upgrade and uses this as a strategy to take advantage of the market. It just really depends, but nonetheless, it's a really great program. Obviously, you have to be able to negotiate with the seller to get this assistance, but it really stimulates buying activity when buying activity is low. If you have any questions on this program or would like to run a specific scenario, would love to help you. Thanks for watching this video.